Tēnā koutou katoa. Welcome everyone, and thank you very much for being here at a later time of the day and for persevering with us going through this practice for the new forthcoming regime around the delivery of our monetary policy statements and OCR decisions. So welcome everyone. Just a brief statement. As you are aware, we've left the official cash rate at 1.75%, and we expect to keep the OCR at this level throughout 2019 and 2020. And the direction of our next OCR move could be up or down. Employment is near its maximum sustainable level. However, our consumer price inflation, core inflation, remains below the midpoint of our 1 to 3% target range, and that necessitates continued supportive monetary policy. Our trading partner growth is expected to further moderate in 2019, and global commodity prices have already softened. We see that as reducing the tailwind that the New Zealand economic activity has benefited from over recent years. The risk of a sharper downturn in trading partner growth has also heightened over recent months, and we acknowledge that throughout our document and certainly around our risk analysis. Despite the weaker global impetus, however, we expect low interest rates and government spending to support a pickup in New Zealand's GDP growth over 2019. Low interest rates and continued employment growth should support household spending and business investment. Government spending on infrastructure and housing also will support domestic demand. As capacity pressures build throughout the projection horizon, we expect consumer price inflation to rise to around the midpoint of our target band, i.e. to around 2%. There are upside and downside risks to this forecast as outlined in the document. More pronounced downturn in global economic activity would obviously need monetary policy to do more work. It would weigh on domestic demand and on inflation. But likewise, if firms are able to pass on the cost pressures they've been experiencing faster than and to a larger extent than what is in our projections, then there's upside risk to the inflation outlook. So we will keep the OCR at an expansionary level for a considerable period of time, and that is largely to contribute to maximising sustainable employment and maintaining low and stable inflation. Thank you very much. I am open to questions, and as always, I have Mr. Jeff Baskand with me, and for the last time we have, for now, we have Dr. John McDermott with us also, and I would like to just publicly thank him for his immense contribution, sir, to the monetary policy statements and economic thought at the Reserve Bank over the past 12 years. I would like to note to the public as well that John will be of more use to New Zealand, becoming the Executive Director of Motu, and so we will be able to continue to use it as advice, but it will probably come at a more expensive cost. Thank you.
Have the chances of a rate cut increased?
No, in the sense that we still see the outlook as balanced to up and down, and that is what we saw, that is what we've had for the last at least 3 monetary policy statements. What we are saying is that it may stay at this level for longer based on our current projections, in large part because of that slowing global economic activity.
So did you give any consideration to a rate cut today?
We've given consideration to rate cuts, we've given consideration to rate rises. That is why we've been running the relative scenarios, but I'd have to say we're very comfortable. We feel the risks are balanced at this point. We're in the watch, worry and wait situation.
And just finally, the reintroduction of your comment that the next move in rates could be up or down, which disappeared from the last statement, what should we read into that?
I think you should read exactly what is written. I don't mean to be glib about that. It was removed last time because we thought it was implicit in the sentence, but it was noticed by markets, so it's just easy to put it back. I think the more interesting challenge for us is that the predictions for the OCR remain at the level for longer.
What's your view on the Auckland housing market? Are you worried that if it continues to fall or speeds up the fall speed up, that it could affect our consumption growth and that could impact the economy?
We've factored in a very, I would say, an historically low level of house price inflation growth into the projections. We have it effectively zero in real terms throughout the projection horizon. That, of course, is for the country as a whole rather than just Auckland. Auckland is a big component of giving us confidence that it will be, on average, that type of low nominal growth across the country. Auckland, without doubt, negative. The rest of the country, or many parts of the rest of the country, is still strongly positive. On average, it's a good outlook. We don't project a particular Armageddon in house prices in New Zealand because there are so many factors that are supporting that asset class at the moment. But we would say that investor perceptions are being tested at the moment.
And what about consumers? Are you worried that if the market does come off, that consumers will stop spending on big ticket items?
Not so much. What we've noticed over recent times is that the propensity of consumers to spend out of their increased perceived wealth from house price rises has actually declined. A lot of what is driving our consumption growth going forward is the fact that people are employed, that real wages are rising, and our projection is for that to continue, both nominal wage rising as well as employment growth being very robust. You know, we have one of the most highly participated labour markets in the OECD, and in fact it's a capacity constraint rather than a capacity concern.
To what extent have you factored in possible requirements for banks to hold more capital in your OCR outlook today?
Yeah. So we've deliberately put in a special pull-out on that topic because, you know, it's a high-profile topic. We put an estimate in there that really says should we go ahead with what we are currently consulting on, and we won't even hear back from the submissions closed for the consultation in early May. It'll be a few months after that before decisions are made. As currently proposed, we would say that it would be lost in the wash amongst many other economic factors that may or may not happen to the New Zealand economy. So we estimate there, you know, possibly a 20 to 40 basis point upward movement in the margin between bank borrowing and bank lending as a transitionary impact, but there are many offsetting forces that will also suggest that not only aside from the margin, interest rates otherwise could be lower because we would have a more safe and sound financial system and fiscal position for the country.
Just to clarify, so today's decision hasn't been influenced by the possibility of what could happen in the future?
No, it hasn't, and we have put there also that it is so small relative to the types of events that generally knock monetary policy around. You know, of course, we will be watching, we will be listening, we will be absorbing the feedback, but at the moment, our core perception is that it's it is a relatively small issue.
A number of other economists, ASB and Westpac, for example, are pushing out the likely timing of the next OCR move because of those capital changes. And UBS, I believe, have got an estimate that of 80 to 125 basis points. Why do you think their forecasts are so much higher than the Reserve Bank's?
Don't believe that, from what I understand, ASB or Westpac, I haven't seen specific point forecasts of what they've suggested, and you'd have to ask them what they believe that is. They've obviously assumed that A, it will go through, and B, they have a point estimate to do that. So that's questions for them. On the UBS one, we seriously struggle with the analysis that has gone on there. It's partial. It's assuming that all of the interest rate can be passed on, will be passed on to only one sector, i.e. those who hold mortgages, and many other kind of assumptions which we just do not adhere to. And I think that at the fullness of time, we're going to be briefing, as you know, media, briefing the industry, and the Deputy Governor, Mr Bascan, will be also putting it on the record speech where we will address some of these issues. But we don't at all buy into that story.
Yeah, I might just add that that is a real outlier in terms of estimates. The other ones that we've seen have been much closer to ours. So, you know, there's a range of uncertainty, as the Governor said, But the other commercial bank, at least ones I've seen that have been had numbers on them, have been much at the lower end.
To think about this, I mean, one, you have to assume you're either in a competitive situation or you're not. In a competitive situation, I would love to be in an industry where you can just pass through every cost increase. I'd love to be in an industry where you could set your return on equity expectations in advance of doing business, but that's not a competitive industry. Likewise, more capital means sounder financial institutions. It means a sounder financial system, and it means less fiscal risk. All other things equal, that means less volatility, lower borrowing costs.
Yesterday in the House, the government said that the economy was strong and growing. The opposition said that there are some problems like the jobless numbers. It's not as good as the government's saying. Who's got it right?
I think that data continues to rise real time. Stepping back and away from the politics of who's got it right or wrong, we're starting this forecast at an economy which is at or near full capacity, certainly with regard to the labour market. It has one of the highest participation rates. We have a low unemployment rate. We see employment growth continuing, and we see demand for labour, particularly skilled labour, as one of the key constraints on growth. So that is a problem, but it's a quality problem. Likewise, we have low and stable inflation, and we have a stable financial system at present. So that's the starting point for our projections on the way through. More recent GDP and labour market numbers continually throw up challenge. As some in the room may be aware, significant revisions to GDP came through, which kind of lifted the level of activity in history, but lowered it in the near term. What that meant for us is we're starting more at a higher level of activity and hence capacity constraints than what the data was telling us until that revision. Likewise, the most recent unemployment or household labour force data has been incredibly volatile. We went down to 3.9, back to 4.3, I think. A huge amount of noise in the data at the moment.
Governor, the assumptions you have about how the capital requirements might affect the economy, do they look at what the banks might do in response? Because in theory, they could choose to stop new lending or deleverage to achieve your capital ratios.
Yes, they do. So we outline in the box, and by the way, this is not policy at the moment, so can we please have that clear? But we knew that we'd have lots of questions, and we wanted to make sure that people's minds were open to how these might work rather than just a person's view. By being open, it can come through the banks. Equity in banks is more expensive to raise than debt, and for a variety of reasons, both the lineup of the risks equity holders have versus debt holders. So the cost of funding could rise for the banks. The challenge will be by how much and what capability do they have to either pass that on or maintain their current level of earnings through taking on other risk or constraining credit. In a competitive market, that will be their judgment on the way through. What we've observed globally, and I'll hand over to Mr. Bascan, what we've observed globally is that well-capitalised banks tend to be able to lend more and be more profitable.
But in the short term, why would they accept these higher capital requirements when they could just go to yourself and to the government and say, if you do this, we're going to stop new lending and hold the economy hostage?
Well, that's an option for them, but that seems, that's an option. I'm not ruling that out, but as I said, it's a competitive market and there are many banks, and all banks are going to be affected slightly differently from these current starting capital requirement levels, from their desire to build their balance sheet, from their desire to become a large bank, so on and so forth. So we have to remember that the return on equity should be related to the risks they're taking. At the moment, the return on equity for banking is incredibly strong. And we would even hazard to say probably over and above the actual risk that they are holding themselves as private banks, because there is an aspect in every OECD country, or in most countries in the world, of the ability to, quote, free ride, where returns can be privatised, losses can be socialised. And what we're saying is, how can we shift that balance back a little bit? Now, if risks decline for banks, so should the expected returns on equity. Every investor knows that you need to be rewarded for the risks you're taking. If those risks have declined, then you would expect some of the reward for that activity to decline.
If you're saying
I would
that
just add, to the Governor's remarks, I mean, New Zealand's banks are amongst the most profitable in the world. And so you're talking about why would they really want to shrink that business in a significant way when they're making large amounts of money out of it. Now, there may be at the margin some areas where they say, well, that risk and reward is a little different, and they'll look at that. But then again, all of that's subject to competition, the ability for somebody else to price that and enter that market. So, yeah, it's possible there could be some reduction, but if there is, we would argue that's because those risks have been underpriced before, and we're getting a better reflection of what society and the country's risk and
in addition,
reward.
I'll just throw a couple of bits as well, because we jump as if we go from equilibrium A to equilibrium B instantly. We don't. What we're saying is that if the recommendations were taken, there is a significant transitory period from which banks have the opportunity to work with us on their own plans on how they will eventually reach the capital requirements. So we're talking, at the moment we put out over a 5-year period. Why 5? Because it seemed long enough to start those negotiations on the way through. So it's not an instantaneous get there. There are many variables, many activities, and holding governments or countries to hostage is, which you're suggesting is one path the banks may choose. It's not in our central scenario.
If you're saying that the banks are effectively charging super profits, they're getting more profits than they should do for the risk, aren't you also acknowledging that there isn't enough competition to get rid of those super profits, and therefore how can you say there's enough competition to keep the banks in the market when there isn't enough competition to keep their profits at a reasonable level?
Excellent question, thank you. A big part around also what we're doing, and one of the net positive externalities if this submission carries on through, is that capital playing field will be more levelled. At the moment, it is and has been used as quite a significant competitive tool for some banks. They have been able to have quite considerably lower, and I know some journalists in the room have held us to task about it, considerably lower capital holdings lending against exactly the same asset classes as their competitor bank. What we're talking about is levelling that playing field where the internal risk-based banks, the advanced banks who have their own models, can still use those as they should be, which is to think hard about how to allocate their capital across the asset class rather than just an outright competitive advantage against any other bank who is entering. That is the idea of having capital weights, so that people think, how are they allocating it relative to the risks? It is not about making sure that I am in an almost superior competitive position to the others. So this capital proposal would significantly reduce the gap between banks around capitals they need to hold, but retain that ability to allocate within banks as banks see fit. Society is safer, competition is improved, and capital allocation is being managed appropriately.
Hi. If the projected pickup in GDP growth this year doesn't eventuate, how would that change your outlook for monetary policy, and could it prompt a rate cut?
Yes, under that scenario, I mean, we're holding rates. We're saying the risks are balanced. One of the risks we say would be to the downside. Of course, that would be domestic demand, and one of the things that could trigger lower than otherwise domestic demand that we see as particularly strong is the global economic outlook. And we highlight China and Australia and recent challenges that they are experiencing around their own growth and how that would feed through. I'd also like to say that a lot of what we talk about in this document is the direct trade impact, i.e. we're thinking about exports, prices and volumes of both goods and services. There are other ways in which global economic growth feeds its way through into New Zealand. One is through headlines and business confidence around investment. The other way, of course, is through financial conditions, and we talk in the document about global financial conditions having become quite volatile and tightening, because as people pull the belts in and get concerned about their own domestic economy that can feed through into the financial markets. So these are the variables we're looking at, and this is our best guess with the data at hand.
Right, I think you partially answered that question, but the statement talks about a risk of a sharper downturn from a trading partner. I'm assuming that's China, and that's heightened over the recent months. So is there any way you can quantify what sort of risk or how big this risk is?
Well, the wonderful thing for New Zealand, certainly over the last 30 plus years, is that we have diversified our trade in both goods and services considerably across countries. And so that means that we aren't held hostage as much as we used to any one specific country. On the other side, of course, China has become an important conduit for our trade, both for direct end goods we sell as well as for intermediate goods that are on-sold. China economic growth has slowed. The official statistics are still 6% north. More recent data, suggests it's probably below that in terms of high frequency data. And so that's why we put that caveat out there that this is a moving thing. John, do you want to elaborate?
Yeah, when you're thinking about international risks and how it would transmit to the New Zealand economy, the first one you would think about is trade, obviously, given what's going on in the world. But if you go back 10 years and think about the global financial crisis, the big factors driving the transmission to New Zealand was the financial channel, so you get big shifts in financial prices, including the exchange rate and interest rates. And the other one, perhaps even the biggest channel, was the confidence channel. The fact that business people in New Zealand see what's going on internationally and react accordingly in anticipation of the potential downturn, and often therefore causing the downturn. So I would be watching a range of business confidence surveys and asking the business leaders within New Zealand, are you concerned about domestic issues or international issues? And if they start saying international issues, then you'd be worried about how it would transmit to New Zealand.
Further to that, what should we make of a bond market that's pricing 10-year government stock at a yield of 2.1%? What does the yield curve as flat as that telling you about the outlook?
That either they're expecting very, very low growth or quite low growth and low inflation. So that is the type of long-term outlook. I have to say it is one of the single biggest question marks left in global financial markets as to what is a long-run neutral level of interest rates. And 2% to us still feels too low. So we've seen how volatile those numbers can be, and we expect that to remain. But 2% is not a long-term sustainable position according to us in our projection framework. Would that be not incorrect, John?
Yeah, that's right. And I think looking internationally too, if you're thinking about US 10-year bond rates, I think the world's still in transition from reversing out its sort of rescue packages for what it did 10 years ago. So again, the Fed is altering its balance sheet, trying to normalise that, and it's removed away from an automatic normalisation, but it's still with the intent of somewhat $50 billion is rolling off each time, and that's changing the risk premium on those prices.
But if you, in a world where the US is running a federal deficit of $1 trillion, 4 or 5% of GDP, and the Fed is also selling bonds into that market, the gap between US and New Zealand rates looks surely as that's going to get wider.
Certainly unusual. Yes, yeah.
It is unusual. We've been, it's a testament to a sound and efficient financial system and how far the New Zealand economy has gone that we are able to independently run our own monetary policy. The exchange rate has been remarkably well behaved over recent times. Now that I'll mention that, it probably won't be anymore. But in terms of those interest differentials, it's held up well. But I think the big picture is what is that long-term level? And we have talked for many years internationally, there's been much investor money put there, that long-term nominal bond yields will rise, but they could rise for good reasons, i.e. more sustained and expected real growth and more normal inflation levels. It used to be, I think it was like 4.5% US nominal, 5% there or thereabout. Or they could rise for negative reasons, where people wake up one morning and think, wow, I might not get my money back at these levels of debt. Our projections are the former, but, more things can happen than will.
We have done some work trying to work out how much it's the expected policy and how much it's the risk premium dimension. Both of them seem to be particularly low at the moment. So, there is that longer term, if you like, low inflation, low growth sort of priced in from a policy sense, and then there's this very, very low risk premium appears to be in the rates at the moment, and that's maybe partly the long-term QE effects, partly confidence in policy settings, institutional arrangements.
And a single global
Both
price.
Both factors are contributing to the lower bond rates at the moment.
The New Zealand dollar jumped 1.3% since you released this decision. Does that constitute remarkably well behaved?
Too early to tell. By remarkably well behaved, I think over a reasonable period of time it should reflect the relative consumer price inflation between us and our trading partners. I can't find the information content in this document, but obviously there's been more buyers than sellers at the previous price. We had a comment that came through that, it's because the risks we show in our document are symmetrical. That just happens to be a way of us explaining the types of things we're looking at and how they could feed through. They are by no means a guess of what might happen next.
This is scenarios.
These are scenarios, where we said it could be lower growth, it could be higher inflation. So
they're illustrative rather than being taken as a quantitative balancing of risk in every sense.
Just going back to the bank capital requirements, how wedded are you to the Tier 1 capital for the major banks being 16%? What sort of capacity is there for that possibly to be lowered through consultation?
We are and will be open-minded to the submissions that come back. That is how we operate, and so that is our core position we put down there, and we are waiting for submissions. We hope they're considered and thoughtful, because we will be when we make final decisions. The real underlying message of our submission document is more capital is better, and better quality capital.
John Kensington of KPMG says that the way the banks could reallocate capital if that 16% Tier 1 level stays could mean that the dairy industry, construction industry and small to medium enterprises could be the areas that the banks don't choose to lend in. Do you have a view on that?
I'd simply say that the risk weightings are remaining unchanged across that. It's the level of capital that we're talking about. So I'm not sure where he's coming from. You'd have to ask him.
Well, yeah, he's saying that the banks will...
I haven't received his submission. I've heard things on the news. So I look forward to thinking about and hearing from him around what that consideration is. I could come out with a million things that could happen, but only some might happen.
Well, he's saying that banks will
make their own judgments about the profitability and risk and reward of particular product and business lines, and they'll have to do that. They do that all the time, and we're not in the business of per se
allocating bank capital.
Yeah, capital.
But he's saying that not only will banks want a higher return, they'll want less risk, and they'll naturally gravitate away from the more risky parts of the economy.
That's interesting. You can choose to believe or not his analysis. If you've got a safer asset, I'm not sure why they should expect a higher return. Likewise, we're not interested in allocating banks credit. That's what banks do, and that's what they're very good at. Likewise, customers can choose to borrow or not borrow, and they can choose to issue debt in other ways rather than through intermediating through banks. So there is many, many, many moving parts that could change rather than just some black and white, some partial analysis.
Recent ANZ bank notes have projected a cut being more likely than a rate increase, potentially down to 1. It's such an outlier compared to your own projections and other banks. Do you get the sense that that bank might be lobbying for a cut in light of the bank capital requirements? Are you getting feedback from the other banks that this is, or all the banking sector, that you need to accommodate?
I strongly doubt that position was put there as a sense of a lobbying for the capital requirements. I think they operate quite independently. The 1% also sits in with the range of possibilities of what could happen going forward. It's not a ruled out possibility. As we said, our best guesstimate at the moment is we hold for a long period. Our next moves could be up or down. So that is, they've got a particular underlying view of the economy which necessitates us having a 1% interest rate. We don't share that view at this point in time.
And the MPS also mentions that firms seem to have embedded low inflation, obviously that impacts on struggling profitability. To what extent are you concerned that the Reserve Bank is unable to affect inflation in the way that it perhaps used to be able to because of these underlying conditions that make it difficult to pass on?
John, do you want to, you won't get to do this very often anymore. So.
Well, not in this forum, yes. So there's been lots of speculation about it. Does monetary policy still work? I think that's true. What we're talking about is it easy to move between 1% and 2%? You're fine-tuning it. And monetary policy has never been that precise. I think if you want to draw the difference between what happened, 20 years ago, or was it 30 years ago now, if you don't control monetary policy, you can get very, very high rates of inflation very easily. So the bank, if it was to target 20% inflation, we could achieve that very easily. It's not what you'd want to do, right? What you're asking is how difficult is it to move inflation between 1% and 2%? And because lots of things happen with the economy and there's lots of surprises and the international economy moves rapidly, that's a difficult task.
I would point to one thing which obviously relates strongly to the credibility of Dr. John McDermott here, but inflation expectations are remarkably well anchored. The 1 to 5 year ahead at the midpoint of our inflation target, and may that remain.
The other thing, you gestured towards it before. Would you be able to speak or tease out perhaps more the revision in the immigration numbers recently and the impact that's had on your views on capacity constraints in the economy and house prices?
Actually, we are waiting to see what that will all mean in the future. So, just for the interest of everybody, they used to collect the little card you filled in when you were flying. It's turned out that's probably not a very reliable indicator. People may make mistakes or change intentions when they arrive. In the future, the immigration service is going to look at what people actually do, whether they stay or whether they go. But unfortunately, that means we're going to have to wait longer for the actual information to arrive, right? Rather than having the intent on the card, you have to wait to see what people end up actually doing. And that could be quite a change in the information content that the bank and actually public other agencies actually see. So I think it's going to be a little bit confusing. In the long run, the quality of the data will be better.
And that latest revision has gone into your projections for this? Because it was quite recently publicised. Has it gone into this MPS or?
So we've taken it on board in a qualitative adjustment.
As best we can.
The problem is you need to calibrate how things used to happen with different data.
Right.
So yes, you take it on board, but you can't mechanically put it in the forecasts.
The scenario you give here about rapidly rising inflation and the factor there being firms passing on costs more rapidly, what do you see, or what do you have the sense of the likelihood of that actually happening?
We sit there as, I haven't got a percentage probability I've had, but certainly an enormous amount of desire, will and signalling from firms exists that they really want to pass on some of the cost pressures that they have absorbed. You see that through business surveys, you see that through our own business visits, and you see it through the compression in the margins that have been going on. We've also seen, and we've been positively surprised, on a frequent basis, around the domestic inflation pressures. So the non-trader, the domestic sector has, that is above the midpoint of the target. The tradable side is below. So where firms can, i.e. where they have the pricing power and they actually have the instruments to do it, they are trying to pass prices through into profit margins. I don't expect to see a sudden floodgate opening of that because the competitive pressures remain as they are. We operate very strongly in a global, low global inflation economy.
Governor, why have you proposed Tier 1 capital levels 16%, which are quite a bit higher than other capital requirements elsewhere? And why have you sort of moved away so much from the convention of the Basel, just sticking with the Basel rules?
Yeah, you've kind of made two propositions that I would disagree with. One is that the capital levels we're talking about are still well within the range of norms. I know there's lots of different measures and coming from different groups with different interests, but we've certainly spent a lot of time trying to compare apples with apples, and we are well within that range of capital requirements. What people have to remember is you'll have your regulatory minimum, and then you have an incredible range of complex and opaque additions to capital requirements from regulators around the world. So the actual capital required from the regulator, plus the buffer the banks are already holding, puts it well north of what the 8 compared to 16. Why we have said let's just make it clear is so that we can, 1, allow people to understand, 2, make sure that there is sufficient and proper quality capital, 3, to be able to better calibrate our regulatory responses to declining capital, which is a #1 global challenge, and we get abused plenty through the press about not being clear enough around our regulatory response, that we can start to say if it goes to 15, expect a letter, if it goes to 14, expect a plan, so on and so forth on the way through. And we all know what that capital is. It will be up to, if this proposals go through, it will be up to the banks themselves to think how much, if anything, over and above that they need to hold to avoid the first phone call from the Reserve Bank. But please do understand that the minimum capital requirement under the Basel is nowhere representative of the actual capital requirements of regulators around the world. And one of the #1 complaints of banks is, why are the regulators continuously in my business? Why are they continuously having to sign off on my risk models? Why are they continuously... It's because of this chicken and egg problem that is going on globally that I would want you to hold more for that risk. Okay, come and see if that risk is now okay. Okay. It is a very, very unusual global behaviour.
Why not remove all of the risk of any sort of bank bailout or high amounts of leverage pumping up an economy by doing what some described as the Chicago plan after the Depression, which said go to 100%?
Yeah, it was interesting. We had one of the global experts on this topic out visiting and doing a public lecture, and a disappointing turnout for that, by the way, from many in the audience here, talking about what would be an optimal capital level after years and years and near Nobel Prize opportunities. He said, I don't know what an optimal level is. Hence, the work that we have been doing where we think that there is a space, a safe zone, where we can have a safer bank without loss of efficiency of what the bank is doing, i.e. we can have a Pareto optimum where we're safer and no one's worse off. And that is what we talk about in the document. That is calibrated. It is not a global scientific estimate, and I'm sure that we're going to have many, many reviews of how we've calibrated and what data we've used.
Just one final one from me on this. does this, if it was implemented as proposed, would this make the need for any deposit insurance scheme less likely because the banking system would be safer?
I think that all regulatory, requirements need to be taken in a holistic sense. And that if you are thinking about deposit insurance, you need to be thinking about that consistent with what works best, what best supports and promotes all of the other regulatory tools we have. Capital is about keeping the bank at the top of the cliff. Deposit insurance is about managing if it's at the bottom of the cliff. If you've got less likelihood of it falling off the cliff, if you've got more capacity to absorb losses, then you may need less of an issue at the bottom of the cliff. The issues at the bottom of the cliff around, will I get immediate access to my deposit? If you make it 100% guaranteed for everything, for the whole world, well, A, that's quite expensive. B, you'd probably need to start building a pot. C, you've probably lent against a lot of the market and self-disciplines to keep the bank at the top of that cliff to begin with. So that is that calibration trade-off. Safety, and then how best to manage a bank crisis.
Have you changed your outlook on KiwiBuild since the last MPS?
Not dramatically. I hope people are aware in the room because we have released also just a separate short paper prompted from our last monetary policy statement. We received lots of questions which Jeff and I proved unable to answer on the spot. So really it just outlines the way in which we think about the net additional building activity that comes from the planned KiwiBuild. We already had a very slow gradual increase in net contribution coming from the KiwiBuild in our previous projection, net rather than the total. We've still got the 100,000, but that's over 10 years. Our projection stops after 3. We're saying, well, what might be happening in the period that matters for us in net contribution? So, no.
Right. And from memory, the link wasn't working when I clicked on it. From memory, it was roughly 7,000 to 14,000 additional homes.
Good memory.
Yeah, so that's roughly what you'll over the next 3 years.
That's the one. Yep. Thank you.
Just a quick question on your process, given that you're publishing a rate decision at a different time and on a different day. Could you just walk us through that? Is it the case that yourselves and the Treasury Secretary met this morning and made your decision this morning and that you're publishing it on the afternoon in anticipation of a bigger committee and trying to shorten the period of time between decision being made and published?
Yeah.
Is that inaccurate?
Accurate in process, not accurate in... basically what we've tried to do is, as best as we can, mimic how it would work in the future. You want to make mistakes while you're practicing rather than on the paddock. And so the way in which it happens in the future is that on the day of the monetary policy statement, i.e. today, the Monetary Policy Committee will agree on the final decision, so it will be made there and then, and we will sign out on the record of the meetings that we've had. So the agreement, the monetary policy statement and the record of the meeting will all be ready and published at 2 p.m. As per today. And so the only document that you don't have today would be a record of a meeting because that meeting didn't happen. I'm still the single decision maker under the law. Of course, I've never actually been in practice. I get no shortage of advice, but so that's the process. So we have a week of brewing up the forecasts and agreeing whether that is a sound basis for deliberating on where the OCR should be. We drop into the newly formed Monetary Policy Committee where we can debate and discuss where the official cash rate should be. We make the final decision on the day because things can happen right up to real time, and we publish the minutes, the record of the meeting, the OCR, the MPS.
And the reason for Wednesday afternoon publication rather than Thursday morning is to...
Because we've got to get all that done in one day.
To
shorten the time between decision and publication.
To reduce the risk, presumably,
That's
of
right.
leaks or...
That's right, yeah.
Exactly.
Because you will have people outside of the Reserve Bank, just to reduce leaks, just to try and make it. Different central banks do different things. For example, some banks publish the record of the meeting a couple of weeks after. We thought, let's have a crack at doing it all at once. I think the Bank of England was our benchmark, wasn't it, to try and get it all done at once?
Yeah, I think they do it on the day now as well. So the common practice is to try and get all the information out together. Otherwise, you get some information, and then if 2 weeks later you get an echo, the markets think you're trying to say something different when you've used a different word to say the same thing, and it's not really a signal, it's just noise. So better to all push it.
We really want that record of the meetings to truly, to get away from glib statements like, oh, your scenarios were symmetric. The richness of the record of the meetings would much better highlight that, we were really kicking around this issue, that issue, and people, all the things that are always talked about inside, so people can get a sense of how we landed. If we can't come to a consensus agreement, the committee will go to the vote. And if we go to the vote will be published. It won't be attributed to the individuals, but it'll have a vote. If the vote's locked, the governor gets the casting vote.
Did you have to have a vote in your practice?
No. Consensus.
Why don't you bring back mock-ups?
Yeah, well, I can't think on the hoof around that, but
well, obviously we did suffer a leak. First time it happens, somebody else's fault. If you allow it to happen twice, it's the bank's fault. And we really need some mechanism, I suspect, that would punish those who would leak. But that facility wasn't provided in the amendment to the Act.
We have no recourse to illegal behaviour.
Is that something you pushed for? Yeah.
Sorry?
It was something that was requested.
Yeah.
Yeah.
I can yell really loud. So what was so you requested that in the Act? But
We suggested it would give us some degree of comfort if there was some type of hurdle or potential outcome for someone who made a leak.
And what was the reaction to that when you asked?
Too hard, too long.
That was the finance minister that said that.
No, that was in the committee, so lost in the wash.
It's sort of you've come to the idea too late. Can you just put it off? Consider it in phase 2.
So is it dead in the water now? So that
Phase 2 still could happen.
no, not phase 2, but the idea of bringing back the lockups.
I think it was postponed until phase 2.
Short answer is we don't see that the risks have diminished under our current circumstances in terms of either ability to sanction, misbehaviour or to control the technology risks and so forth, and the sensitive market-moving information, and we need to keep it.
Increased to the extent that it's a wider committee. The decision on the day used to be the governors in a very small group, and it was finalised and sent out almost immediately now because of the other requirements of the remit and the charter, which we'll be talking about tomorrow. There's there's a bigger process that has to happen before we can wave the flag.
How would you have liked to have punished us?
You personally, Bernard?
have to read the monetary policy statement. So. Wonderful. Thank you very, very much, everyone. And once again, just before I close off, thank you, Mr. John McDermott, Dr. John McDermott. Good luck for the future. Thank you.